Good evening, ladies and gentlemen, and a warm welcome to this one of its kind webinar exclusively for our Yes First and Yes First for business clients. As you're aware, Yes First is a Yes Bank's premium banking and wealth management program, and it is designed to provide delightful banking experience to our esteemed customers as yourself. I'm Anshumal Pandey, Head of Task and Yes First Business Program, and it's my privilege to welcome you all to this highly requested webinar, Mahurt Musing, Unfolding the Essence and Credence of Indian Equities. Let me introduce you to our guest for the evening, Mr. Amar Ambani, Head of Institutional Research at Yes Securities. Amar is a Group President and Head of Institutional Equities Business and Research Strategy at Yes Securities, a wholly owned subsidiary of Yes Bank. Further, Mr. Amar plays an integral role in boosting the company's market access and procurement capabilities. He also steers the investment committee guiding on the strategic asset class views and tactical allocations. He has nearly 2 decades of experience in capital market. He was previously partner and head of research of, of IIFL group of companies group and a director of the board of IIFL subsidiaries. He has played a pivotal role in creating disruptive investment plans and products, formulating broking strategies, digital initiatives, and nurturing a vibrant advisory culture. An MBA from Wellington Institute of Management and a certified business process re-engineer. He has also conducted numerous corporate roadshows and investor camps and played a key role in many institutional empanelments. He also published a book, 108 Mantras of Financial Success, a category bestseller for his previous organization. Before we start with the webinar, I would request all of our esteemed guests to kindly put any questions that you may have on the Q&A box so that I may present it to Amar. So without any further delay, over to you, Amar.
Thank you. Good evening, everybody, and thank you for joining this call today. I hope you all had a lovely Diwali, and I wish you all a very prosperous New Year ahead of us. Now, we've had a roller coaster time for markets and economies, not just India, but the world over, whether it be COVID in 2020 and the re-emergence of its variants, whether it be the Ukraine-Russia war, whether it be inflation, which is currently haunting the entire globe, the China slowdown, which is underway, given the kind of strict COVID lockdowns that they're doing there. And obviously, you're seeing the dollar also strengthening versus every currency out there in the world. And all of this kind of just disrupts and also confuses everybody across the globe on how they should go about investing. And to just try and make some sense out of all this chaos which is going around, let me just summarize what my view is for Indian equities in a couple of lines, so that at least that is out there right at the start. And then maybe I can expand on why I think what I think for Indian equities in the near term and in the long term. So in the near to medium term, so if I had to kind of break it down into near term, medium term, long term, I think in the near term there could be some correction in equities, and we know markets have gone up a lot, and in the medium term too, there is a lot of vulnerability for Indian equities as well as global equities, and therefore I think being stock specific will be the best thing to do at this juncture. But slightly longer term, I'm structurally bullish, and I don't mean 10 years or 15 years, or I don't have predictions that far ahead. When I say I'm structurally bullish, obviously bullish on India for the long term, but bullish on Indian equities for the next 3 to 4 years. So this is my broad summation of what I think in the near term and long term. And now let me elaborate on why I think so. So in the near term, I say a correction is possible, and not necessarily a big one, but some healthy correction can come through. And the reason for that is that, end of September, I think the Nifty was somewhere close to 16,800 or so. And in just about a month's time, we've crossed 18,000 on the Nifty. That's almost 1,400 points on the Nifty in just 1 month. So given that kind of a move, that's one of the reasons why I wouldn't be surprised if there is a correction that comes through. So we are very close to retesting the previous highs and maybe even briefly surpassing them. So when I look at the charts, when I look at the structure, when I look at the derivatives data, when I look at sectoral contributions, it seems like there is a little bit of overboughtness on the charts currently as far as the Nifty is concerned. And the other thing is that I don't see any triggers or any new triggers currently. Uh, Whether it be results, whether it be a possibility of Fed or somebody saying that, listen, we're going to now halt these interest rate hikes. Any of these factors, I mean, I really don't see any new triggers immediately for the market. Talking of results itself, I mean, we're in the thick of the result season currently in India. And of the 180, 185 companies that have announced results that we've tracked so far, the data isn't very encouraging currently. So if you look at X banks, right, if you put banks aside for a bit, and then if you see how the results have panned out, then the EBITDA or the operating profit of these companies, about 130, 140 companies, X banks, has dropped by 8% on a year-on-year basis, and the profit before tax has degrown by around 20%. This obviously is attributable to the jump that we've seen in input cost, in raw material cost, in power and fuel rates, and also in freight rates. So this is the reason largely why we've not had a great season so far. However, bank results have been very good. And if you include banks in the overall results, so to these 130 odd companies, if you add the banks as well, so if you look at around 180 or 170 companies, including banks, then it's been flattish. It's not grown, but it's not degrown as well to a large extent, and that's because bank results have been pretty good. So at least we've not had great results for result to be a trigger for the market. Neither do I see any other reason or any other trigger immediately paying out. The other thing is that the other thing that I look at is margin of safety. In times when it becomes difficult to predict where the market is going, or make sense or binary logic, or place five things why they should go up right now. In the absence of any of such things, the other thing that I look at is margin of safety. Because if there is margin of safety, at least you know that there will not be a large drawdown. And currently that margin of safety is missing. So the markets have run up a lot, looks a little overbought on the chart. Margin of safety, like I said, is missing. So from a valuation context, I mean, if you look at it in context of bonds or yields as a competitive asset class to equities, then these rising yields, which are also likely to rise further, obviously are not great news for equities in the near term. So this is the near term view. A correction is possible, maybe not a big one. However, likely that maybe briefly after we cross the new highs, the market could correct a bit. What am I seeing in the near term? Things are looking better or healthy in the near term. They're not looking very bad. Reliance, for one, the biggest heavyweight on the index, is looking pretty strong. It's consolidated for some time now. It's been consolidating for many months, and it appears as if it could be an outperformer in the medium term. Then you look at banks. I've already mentioned that banks had good results so far, and the banking sector is looking strong. So that is another heavyweight on the index that looks good. Whether it be the NPA cycle, which is behind us, whether it be NIMs, which are stable and maybe they'll inch up going forward, all of these are reasons to believe that banks will do well. Then you look at another heavyweight, say IT. I think IT stocks have fallen as much as they could, in line with what is happening globally and in line with fall of the stocks in on the Nasdaq. But I think both from a fundamental point of view, from a valuation point of view, and also from chart point of view, it appears as if the worst is over. Not to suggest that there will be a runaway rally in IT stocks, but they are on a strong base now. So from here, maybe they'll consolidate for many months, but at least it is not a drag on the market, or it will not be a heavy drag on the market as they've been till some while back. So if you look at this 50% or 50% plus weight on the index, whether it be Reliance, whether it be the banks, whether it be the IT index, I don't see a major problem in the near term. However, I will say that vulnerability is very, very high for the market in the medium term. The next few months, the chances, or I would say that there is a possibility, and a very high possibility, that there is a sudden shock or bad news anywhere in the market, in the global economy, which could cause a significant correction at any point in time. And let me give you, some examples. For example, Russia, obviously, in the name of maintenance shutdown, already switched off one of its gas pipelines, and which caused oil prices also, gas prices also to go up, and more importantly, it resulted in lesser supply of gas to certain key European nations that they were supplying to. So any of such mischief, if I can call it that, can lead to a shock and consequences for the market globally or in India in the medium term. Then take sabotage as another point. If there were to be a sabotage of a gas pipeline, or if there was to be a sabotage of these global assets, a lot of which are underwater in deep seas, you have these huge fiber and cable network that run internets and power connections that run through the deep seas, and they're not guarded. It's difficult to guard them. They run across country boundaries, and if there was some sort of a mischief or sabotage that happens there, for example, then that would again mean a trouble for global equities. Europe in its winter is going to desperately need all the heat and heating that it can get to power its homes. And at that point, if Russia pulls the plug on another gas pipeline, then we're staring at again trouble for global economy, and therefore cascading impact on the market. Fed obviously will hike rates a little more. The chances are that they will do a 75 basis points hike again, and after that maybe another 75 basis points in part or full. But there are some murmurs around maybe a possibility of a slightly higher hike that comes through as well. So if that happens, then again, that's bad news for the market. China, US, of course, tensions are pretty high right now. So for all of these reasons, there could be any bad news, which is why I say vulnerability is high. Any bad news that comes and impacts markets. Just a couple of days back, I was reading on Russia calling off its arrangement with Ukraine to send agri stocks overseas. And if that agreement therefore is pulled out, it means that again agri prices across commodities could go up. So you cannot rule out any major correction and a serious material one coming through in the medium term. And that is the kind of precarious situation that we are facing currently, that there is no one clear view in the near to medium term. Markets have obviously run up, but if everything is fine, then there'll just be normal corrections. But if any of these vulnerabilities were to manifest, then there could be a material correction, and I cannot rule out in that case our Nifty is say correcting even to levels of 16,000. So the best thing really to do at present is to remain focused on which sectors you want to place your bets on, and which stocks within those sectors that you want to place your bet on. And ideally, of course, this is the approach that you should have always, but I think this is more true today than any other time. Therefore, I think rather than overly focusing on where the market can go, because it's really, really difficult in the near to medium term to gauge that, the best thing to do is look at margin of safety, look at which sectors I want to place my bets in, which are sunrise sectors, and within those sectors, which are the stocks or companies that I should own, and then at what price is a great price to enter. So if in any correction you get that price, then that's the time to lap them up. So this is my view for the medium term. So that was on the near and medium term. Now let's go to a slightly longer term view, which I've already mentioned at the start, that I am structurally positive, and from a 3 to 4 year time frame. Uh, to begin with, let me say that the world economy is not in bad shape. It's not in as bad a shape as it was in 2008 when we had the global financial crisis. Not Europe specifically, because Europe is obviously in deep trouble. But if you keep Europe aside, if you look at US, and the reason I focus on US is because US accounts also for 80% of the world market cap. So if I look at US, then I don't see any housing bubble there. I don't see any financial market bubble out there. And employment, of course, is very, very high. Unemployment is very, very low. And for those reasons, at least I don't see US in a very, very bad shape. If you look at China again, most of China's problems are self-inflicted because China has done this zero COVID policy, forced lockdowns, and therefore, whenever China decides to open up, I think the Chinese economy also will bounce back, and therefore next year we will see better growth from China as well. Then, a lot of people talk about stagflation and that US is in a stagflation situation, the world is in a stagflation situation. Uh, if I talk about US, I do not think it is in a stagflation. What is stagflation? Usually people think that stagflation means there is high inflation and there is slow growth. But actually, that's not the case. Stagflation is a state where you have high inflation and you have high unemployment. Currently, we do have high inflation, which is supply side, not demand side. But we have a situation where we have low unemployment in US. Uh, Anybody and everybody who wants a job is getting a job out there. So therefore, I do not look at this situation as a stagflation. So that is the other part, which is why I believe that we are not as badly placed as we were in 2008. The other thing from a slightly longer term point of view is that whenever global bonds uh, stabilize, whenever Indian bond market stabilizes, and whenever the INR stabilizes, I think at that point we will have a situation where equities also will stabilize, and in fact that may lay the foundation of things getting much better, clearer, and a structural rise for equities from there. Because currently bond yields are rising, rupees depreciating, and therefore equity markets are also nervous. But the day this happens, I think we will start seeing better times for equities. And why I think that will happen? Take inflation first. Again, if I talk about US inflation, in my opinion, will peak at some point, maybe the next month, maybe the month after that. And the reason is that one, these rate hikes that they're doing, because the US economy does work a lot on borrowed capital, unlike India. And therefore, these rate hikes will to some extent slow down demand, and it will also tame inflation expectations. The other thing is, like I spoke about China, China has kind of shut down very hard due to COVID. And once China starts to open up, we will start seeing supply resume from the Chinese markets as well. Similarly, all the supply related issues which are linked to COVID, whether it be shipping, whether it be disruption in labor, or for that matter, any other input or variable that has caused a disruption in supply due to COVID, once that starts easing up, then you will see those channels of supply also starting to open up. Now, oil is, that iffy, that can either go here or there. Barring some shocks in between where prices may jump suddenly, our belief is that oil will remain elevated but stable in a range which is, say, between $90-$95 to maybe 110, 115. It's still a broad, large range, but even if it stays at these levels, the base effect from these levels will mean that going forward, inflation on account of oil at least will not happen. In between, like I said, there will be shocks, and those shocks can result in oil jumping to 130, 140 also. But I think that could be short-lived, and maybe it will come back to the range that I'm talking about. So once that happens, that also incrementally will not be a negative as far as inflation is concerned. Uh, you look at other global commodities also, they've started slowing, they've started kind of cooling down. And therefore, that also is good news for inflation. You look at India's inflation, then I would say it's very, very transient. Yes, we will have the odd jump. There's agri inflation currently because of delayed rains, or rather delay in withdrawal of monsoon. Now there is a fear that even vegetable prices will go up. But by and large, if you look at core inflation has remained over 6% and is likely to be sticky. And I think what RBI has done as far as rate hikes is concerned, broadly is sufficient to tame inflation and inflation expectations in India, right? So US Fed will raise rates maybe by another 150 basis points, uh, and therefore their Fed funds rate will go to 4.5%. But US Treasury yields, which have already run up from 2021, they ran up before Fed started raising rates in anticipation of inflation going up and Fed raising rates. So US Treasuries, which are already running up since 2021, will possibly pause at around 5% level also. Similarly, Indian GSEC yields also were rising even before RBI started raising rates. And we already, I think, went close to 7.75%, and then we kind of recovered a bit. I think maybe we'll go to the extent of 7.758%, and we'll pause there. And once that happens, Indian bond yields also will pause. So US yields will pause as say 5%, Indian yields will pause say at around 7.75% or 8%. And therefore, bond markets at that point will stabilize. In fact, if you look at the Indian context, I think from here on, there is no need or hurry to raise rates from here, the repo rates from here, on account of Indian inflation. But because the US Fed is, raising its rates, and because the RBI also has to kind of defend the rupee, we may see obviously some more repo hikes coming through. But purely from an inflation point of view, if rupee was not a factor, then I would imagine that RBI may even consider pausing at this point. So I think India is far better placed. And if I look at the global structure of inflation and also interest rates, I think bond markets will stabilize at some point in time. Uh, Similarly, if the rupee was to stabilize, and our in-house view is that maybe at 84, 84 and a half level, rupee will stabilize. If that happens, then again, you will have a situation where the currency market in India is also stabilized, and FIs can start taking a more positive view on India, because what they look for is a stable currency besides a vibrant equity market to invest in any country. So if the Indian rupee is stabilized, it means that they can again come to invest. In fact, let me give you some interesting perspective on FI investments in India. I would say that we have in the last few years not seen, uh, uh, or we've just seen the tip of the iceberg as far as FI investing in India is concerned. The number might look big in the past, but it's not that big, trust me. The reason I'll tell you, and I'll give you with certain figures and percentages. So in the 2003 to 2007 cycle of the bull market, FI inflows in India as a percentage of market cap at that point in time were 2%, around 2%, 2.3%, 2.4%. That's the kind of inflow that we saw in Indian equities in between 2003 to 2007. Between 2009 to 2014 also, barring 1 year, FI inflows were anywhere between 1 to 2% of market cap during that period. And FI or 2015 onwards, We are yet to see such kind of inflows as a percentage of market cap. What we've had compared to those 2% or 1.5% kind of inflows back then, what we've had since 2015 is just about 0.1% to 0.9%, so not even 1% in all the years. And in 2022, in fact, we are seeing outflows. We've already seen an outflow of close to 1% of our market cap by FIIs in 2022 itself. And therefore, my belief is that they will not be in a hurry to sell. And as soon as bond market stabilize, as soon as the rupee stabilizes, they will be back. So this is the other reason why I am structurally bullish on Indian equities. And this is my view, like I said, for 3 or 4 years. The other reason why, again, I'm bullish for 3-4 years. One is because, like I said, I don't think the situation is as bad as 2008. The other thing is that what do countries do to push up their growth rates? In the past, governments used to run fiscal policy, and that's the tool that they used to use to take, to help the economy, boost the economy, or to kind of pull away if they wanted. Then they started running the monetary policy too. Now, what governments are doing across the world is they've taken control of banking. So I'll give you figures for this as well. It's already started to happen. Out of all the new corporate loans that are going out in a lot of places in the world, a lot of them are getting guaranteed by the government. Take Germany's example. All incremental loans that Germany is making, 40% of them are getting guaranteed by the government. In France, the number is 70%. And in Italy, the number is close to 100%. So 100% of incremental loans given by the Italian banking sector is guaranteed by the government. So the government is now using this as a new weapon or a new tool to ensure that nominal GDP growth stays up or goes up. And the best part is this is not even on the government's balance sheet. This is going to be off balance sheet. So for this reason, I feel that going forward also, things will get better. So all that the governments also will largely wait for, or the world will wait for, is for Fed to pause on rates. If the Fed pauses on rates, once they do that, and maybe quantitative tightening also will not happen at a fast pace, you will see a scenario where things will start to improve. In fact, once Fed is done with their rate hikes, I think next year at some point they will start cutting rates as well. That might happen after mid of 2023. It's too early to say right now, but I have a feeling that Fed will definitely start cutting rates next year once they start seeing inflation come under some kind of a control. Already there are murmurs and talks that it is recessionary just raising rates, because it's a supply side problem, and raising rates is not going to help. You need to address the supply itself, and I think that is a talk which is getting stronger and stronger. So this is the reason as far as the globe is concerned. Now let's come to India. Why does India stand out? As long as crude oil and commodities are in check, that is great news for India because it's a importer. There will be shocks in between, like I said, but the world is hell-bent on diffusing any commodity bubble as fast as it can. So anytime commodities go up, these bubbles will be addressed, and everybody wants to break these bubbles fast. You look at the bank and the NBFC also in India, they are now fully capitalized. You are out of your 10-year bad cycle, and you are now finally fully capitalized. So the banking sector is in a much better shape in India. You look at the housing market. There's no bubble in the housing market in India also. We've seen inventory correction over the last several years, and now the housing market is in a much better shape. You look at our digital economy. We've supercharged in the last 2-3 years, thanks to COVID, into a vibrant digital economy, and that is going to help accelerate our growth going forward. The only other markets which have been growing like India are Indonesia and Philippines in the emerging market basket. But here too, while the growth profile has been similar to India in the past, these countries are witnessing downgrades and India is not. Consumption wise, also, currently, of course, things are not great, barring the festive season, which saw pent up demand. Uh, but this is a self serving economy, and therefore, we'll have enough demand domestically. Government capex also is a big positive, and the government is continuously being the sole driver of capex. Private capex is slow, but I think some schemes like these PLI schemes and some countries taking the view of China plus one is bound to help to some extent on the private capex side. But by and large, I think government capex is a big plus. Balance sheets also in India are very strong. Everybody's raised money, and whether it be equity, whether it be deleveraging of their debt, all of that is done, and therefore balance sheets are very strong. So I think from that point of view also we are on a strong footing. If you look at base revenues also, I think we are on a strong footing. Last 10 years, almost every sector has gone through a bad cycle and come out of it. And I was talking about results this quarter not being that great, and that was largely on account of raw material prices going up, input costs going up, fuel going up. But if you look at commentaries of all companies, then everybody's of the opinion that from here input prices are softening, and therefore EBITDA will go up in coming quarters. In fact, all these companies that have taken price hikes, they may not increase or they may not reduce their prices even when raw material costs go down, or they might not at least reduce it to that extent, which means there is a scope for their margins also to expand. Inflation dynamics are much better in India than the world, and the domestic liquidity also is extremely strong. So we've been seeing that the markets also have been held up, or not fallen to the extent that they possibly could, or they have in the past whenever FIs have sold, and that is because there is ample domestic liquidity that's been buying at one end when FIs have been selling. Finally, I'm a big believer in market cycles, and I feel that the market cycle at this point in time is favoring a rise in equities for the next 3-4 years rather than a big bear market for the next 3 or 4 years. I always term the market as Mr. Market. The market knows better than others. There's an old saying, "Bhav Bhagwan che," and I firmly believe in that. And I get the feeling that Mr. Market does not want to fall heavily, or anytime it falls heavily, it immediately wants to recover. And we've seen that post demonetization, we've seen that post COVID, we've seen that post this Russian crisis when the markets fell. Every time the market has fallen, it's bounced back immediately. So I would say that one strategy should be to buy any correction. Buy every time you think there is a correction and there is a margin of safety which is high. Structurally, 3-4 years, I think we have a bullish period, and we should use this vulnerability or the volatility to help our portfolios by identifying the stocks, the prices at which we want to buy them, and buy them whenever that correction comes through. So to sum up, to reiterate, like I said, near term there is vulnerability, possibility of a correction, but focus on sectors, focus on stocks, and you will do well as far as your portfolio is concerned. So buy whenever there is a margin of safety, and I think we'll have a great time in the next 3 or 4 years. So thank you, and on that note, let me just end my session and hand it back over in case there are any questions. Thank you.
We have a few questions from participants, and I think while you may have some of them came while you're talking, I would still want to take them. So to begin with, the first question which came was, which are the sectors which you are bullish on and bullish on in the medium term, and which sectors one must avoid?
Right. So yeah, given that I've spoken about focusing on sectors and stocks, uh, when you're not clear about the market, uh, one sector that we like is the banking space, and I've already spoken a bit about this during my session, because the banking space has gone through a bad loan cycle, a provisioning cycle for the last 10 years, and finally, I think all the provisioning that needs to be done has been done. incrementally from year on, there can be write backs. And in fact, it's gone through an acid test also. I mean, even when everybody thought provisioning was done and then COVID hit, everybody thought that now there will be incremental stress and maybe a lot of stress from MSME, a lot of stress from rural, but that's not come through. So I think they've also shown their resilience, and they've managed that period. And therefore, from here on, I do not see any bad asset of the past or any fresh bad asset cycle impacting the banking sector. Uh, I think incrementally going forward, we'll only see banks and NBFCs doing well. So this is one sector that we like. The other sector that we like is real estate. And I think again, year two, after years of being in the doldrums, we've seen a lot of inventory correction has happened. And in fact, if you put aside the high cost inventory or these premium properties which are stuck and may remain stuck for a long time, if you set aside that data, then the data looks even better. The amount of momentum and velocity that we are seeing in budget and affordable inventory is phenomenal. People are buying homes, and developers also are in a better situation currently. So real estate is another sector that we like. Infrastructure, again, the government is going to relentlessly invest in infrastructure, and therefore this space, anybody who's doing anything related to EPC will do well. And because we like real estate and infra, I think the building material space, anything to do with paints, tiles, plastic pipes, cables and wires, all of this will do well because they'll be used in infra also, they'll be used in real estate as well. So these are some sectors that we like. As far as stocks are concerned, let me maybe stick to only the large cap and the larger mid caps for now, because sometimes when you're talking to a larger audience, you may give away a small cap, mid cap, and then have a change of heart or view, and may not meet that person, and therefore then that would not be right. So if I have to talk about some stocks, then obviously an ICICI Bank or any of these large banks look good at the current juncture. Uh, we since I spoke about cables and wires, Polycabs is another company which is a larger mid cap stock which we like. I think given the PLI schemes, something like a Dixon should do well. I think at a slightly lower level, something like a ICICI Prudential Life should be evaluated. Um, I think these are some stocks that we like, and there's another company, but of course there is currently trouble in Europe, so maybe not immediately, but you can keep it on your radar. I think Sona BLW is another stock which is also a play on the E theme. So if you get it at better levels, at better valuations, this should be a stock on your watch list, not to buy immediately, because they do have business in Europe, which is bound to get impacted. But if you get this stock maybe 10-20% lower, then this is another one that you should keep on your radar.
Thank you. There are a couple of more. I would ask them together. One is, when do you think the 10-year GSEC rate yield peaks, and when do you think the rate hike will pause or start falling down again? Is it some 2 years away? I think you covered this in your speech. And the second one is, are you indirectly suggesting that we increase the percentage of cash in the portfolio at least for some time to ride the current uncertainty?
Right. So, yes, I did cover. So, as far as yields are concerned, my view is that yields have started going up even before these rate hikes started coming, whether it be in India or whether it be by Fed. Uh, and therefore, uh, it's not as if Fed will raise rates from here by say 150 basis points. So the US yield also has to rise by the same percentage, and which is why I feel that maybe the US Treasury yield at 5% and the Indian yields at 7.75 or 8% may be hitting the top at that point. So I think that's my view as far as where they can peak. When can the rate cycle start turning? Well, it's a difficult one to answer currently, because while I feel bonds will stabilize, it's too early to say that interest rates will start stabilizing after, or start falling after 1 year or 2 years, because uh, one is that inflation is bound to stay elevated. My only view is that it will stop going up and slightly inch lower at some point in time, but it does not mean that it will fall significantly for any central banker to take a view that we must not now start cutting immediately. It's only the Fed that may next year at some point cut slightly, because they might overcompensate by increasing rates much more than they ideally should. So I think that overcompensation again next year they might want to correct at some point, but that does not mean that they will significantly reduce rates, uh, because inflation will stay elevated. The other thing is, I also spoke about these governments now using banking as a tool to prop up growth. And if they guarantee loans, and if that results in the credit offtake being much higher, it also means that inflation that also means that it is inflationary. So that is something else that will keep inflation slightly elevated. So for this reason, I will not at this point want to guess when it will start falling. Uh, but yes, at least the rise can pause. As far as the point on raising cash is concerned, yeah, I think what investors can do at this stage is either raise cash a little, because, like I said, in the near term, the run up has been very fast, and the margin of safety is not very high, and I don't see any new triggers. And in fact, I do see these vulnerabilities which can come and cause a correction. So yes, raising cash is not a bad idea. Any stock where you think valuations are at a premium, you must reduce your positions. Obviously, if you're structurally positive on a stock for 3 to 5 years, then that may be another case. But anything that you wanted to sell, or anything where you think valuations are at a premium, then you can sell and raise some cash. There's no harm in keeping some dry powder for the right moment, because you will at any point in time get a good correction, or a point where margin of safety will improve, and at that point you can always reinvest. The other thing to also do for any savvy investor, either directly or through structured products, is kind of buy a put, and to that extent reduce the risk of the portfolio. So yeah, there are these couple of strategies that some people can follow, but yeah, there's no harm in raising a little bit of cash.
A few more, Amar. Electricity subsidy announced by Germany is going to impact Europe, and is it subsequently will it also impact the global economy, seeing the market scenario? That's one. And the other one is, where do you see Nifty 50 in the medium term to rise? When do you see Nifty 50 in the medium term to rise?
So Germany thing is a problem with the whole of Europe. I mean, obviously, we saw recently when the ex Prime Minister of England, who's no more the Prime Minister, but for a brief period that she was the Prime Minister, she came and she announced these subsidies and this big package. And we had the pound also going for a toss, and the yields there also going for a toss, because there was no clear communication, and there was an absolute doubt on how this is going to be funded. So I think the same problems will haunt Germany as well. And Europe is in a mess. I mean, so it's absolutely impossible to predict. I mean, it's almost fearful what's going to happen in the peak of winter out there. uh, so I mean, your guess is as good as mine on this one. As far as Nifty 50 is concerned, again, like I said, difficult to gauge, but looks quite overbought. So I would imagine that briefly it can cross uh, or stay above the previous highs, and after that maybe some correction comes through. Whether it will be a big one or maybe just a 2-3% correction, we'll have to wait and see. But yeah, I think that is when I think the correction should come through.
A few more. One is on gold. What's your view on gold for the one on gold as an investment asset class, and where do you see it moving for in the 1 year term? And the next one is, uh, the road ahead for auto, particularly with reference to Tata Motors? Auto sector, he's asking, the question is on auto sector and with particular reference to Tata Motors.
So on gold, I have been negative on gold for some time now, for many years actually, and I track gold on dollar terms. So my view is always in dollar terms. The rupee rate of gold may appear to be different because rupee has been depreciating, and therefore in rupee terms, gold will be appreciating. But when you track gold as an asset class to form a bullish or a bearish view on it, it is best to look at it from a dollar perspective because that's how it's traded and quoted globally. So, from a dollar point of view, in gold, I have been bearish for a long time. Uh, and it's been playing out that way, barring a brief period during COVID when gold started inching up. And I think the reason at that time was that people feared that there'll be deflation around the world. But as soon as people got the feeling that no, there's going to be no deflation, gold in dollar terms again started coming down. I haven't seen the price in the last few days, but the last I saw it was around $1650 or so. So it's been sliding from its highs, and my view is that it may slide down to 1250 or $1300. And the reason for that is that gold does well during times of hyperinflation or during times of uncertainty and deflation. And currently, we don't have those scenarios. Secondly, yields are inching up, and therefore, you have interest bearing assets which are giving you more and higher yield by the day. And therefore, why would you invest in an asset that gives you nothing? Uh, so, even if you look at cryptocurrencies or Bitcoin and all of the likes, they've also been kind of falling because anything alternate to equities or fixed income is frowned upon right now. In INR terms, of course, like I said, INR has depreciated and therefore gold has gone up. But if our view is correct and if INR stabilizes, then I think that also will pause. And if at some point in future, if the INR was likely to appreciate and say uh, go to 78 or 79 or levels like that, then in INR terms also you will have a fall in gold. So I think one last leg of fall in gold is pending in dollar terms, where it can go to 1200 or $1300. Post which times at least a base would have been formed, and post which times can improve. But I'm looking at gold turning attractive maybe 3 or 4 years down the line when I'm a little less sanguine or bullish on equities. Till then, my view stays that gold will be in a long bear market cycle. On the auto sector, we've seen a good festive season as such, but going forward, whether people will continue to buy with the same exuberance, also given that auto loans are getting expensive, uh, and the fact that there are their own challenges within that sector, about who will be able to successfully make the EV transition. Uh, will, especially in two wheelers, will the old hands like Bajaj, TVS, Hero uh, be dominant force in EV, or will Ola and all the other newcomers that have come through, will they have more of the market share? So those questions remain unanswered, and therefore to that extent there is uncertainty. Also, if you look at some segments of the auto space, like say take two wheelers, then I think it's a market which is 70-80% already penetrated, and therefore barring replacements, there is not too much scope for it to keep growing the way we've seen in the past say 20 years. Commercial vehicles, though, I am a little more bullish on, but specifically on Tata Motors, so I think their commercial vehicle segment in India will do well, and they've done good launches in passenger vehicles as well. So I think that also will do well. But the bulk of the value of Tata Motors, 70-80%, does come from JLR. And again, that raises the question on uh, what happens in the world economy and how will those sales in China and Europe do going forward. So I think that question mark is there. So it's not a table thumping buy as such. But again, recently one of my analysts was telling me that in case somebody wants to look at Tata Motors, then they'd be better off looking at the DVR, because I'm told that the gap is kind of increased. So if you have to buy Tata Motors, then buy the DVR.
One more reference to the Europe. Uh, Being Europe and US is impacted badly economically, how would you take Nifty IT in the near midterm?
So I think Nifty IT, I think, has fallen to I would say to an extent which is now at a comfortable level. I think if I look at from a chart point of view also, uh, I think it looks at a long-term support zone to me. If I look at from a valuation perspective also, it looks attractive from the long term. I think there is value that is emerging in the IT tech. If I look at from the deal pipeline point of view of these Indian IT companies, that too, the momentum has not gone away. TCS is still clocking $8 or $9 billion of deal pipeline every quarter. Uh, and therefore, that also makes me not change my view. And then if I look at the NASDAQ also, again, there chart wise, it is comfortable. And if I look at, say, FANG stocks, if you look at the earnings, or you look at the P multiples of some of these stocks, whether it be Facebook, uh, Netflix, Google, um, uh, look at some of these stocks, I think the P multiples are also closer to 18 or 25, which means that that excessive froth from those stocks also is out. So I'm not any more underweight or pessimist on Nifty IT, but I think for many months it will consolidate. It will consolidate for the simple reason that people will fear that given the global slowdown, that global companies will cut their budgets, and that will impact these companies. Uh, they will fear that any further fall in global stocks will result in fall in stocks out here also. So I think for those reasons, the index will consolidate for many months, and only after that it will start outperforming the market. But from here on, I do not imagine that it can fall heavily. In fact, if you get the slightest of falls, I think it's a good time to start accumulating if you have a 3 4 year horizon. And if you are, say, a balanced or a conservative investor. Obviously, if you're an aggressive investor, then you look for sectors that are growing more faster rapidly. But if you are a conservative or a moderate investor, then these are safe blue chips, and the margin of safety is getting better, value is emerging, and you should look to buy.
Two more. One is, if you're bullish on the Indian economy, do you also suggest that one should invest on high risk stocks as well? And second, your views on defense sector, if you can cover.
Actually, I never believe in investing in high risk stocks. Uh, Equity market itself, many consider to be risky. I, in fact, don't consider equity markets to be risky. I only consider them to be volatile. Unless, of course, you've got into a penny stock, or uh, in the face of volatility, you get scared out of the market. Uh, or, like I said, if you've taken a bad, very, very bad stock, a penny stock, most of which are obvious to people that they are horrible, but for some reason, people still buy those. So unless that is the case, and then you don't live to fight another day, you lose, you're stopped out and you're out of the markets. Unless that is the scenario, I don't think stock markets are risky. They are largely volatile. And if you can ride through this volatility, then you are a winner for sure. Then whether you do exceedingly well or you've done moderately well, that's another story. That depends on so many factors, like your acumen, your investing skills, and all of that. But not wanting to beat your neighbor in returns, if you're happy beating fixed income returns, then you will not be a loser in the stock market, as long as you can patiently hold and not lose your nerve when the volatility is there. So from that point of view, I don't ever think you should invest in a risky stock. So there is nothing like a risky stock. Those risky stocks, in my opinion, are penny stocks, or stocks where there is, people know for sure. There have been some companies in the past who've gone to NCLT, they are still trading on the market. You know that they are surely going to 100% write off all their equity and come out of NCLT as a new company. Still, for some reason, their prices are 1 rupee, 3 rupees, 5 rupees, and people are still buying those. The other short way of losing money is buying businesses that you don't understand. If you don't understand a fintech or any of these startups which I've listed, if you don't understand their business models, best is to stay away, because these companies are not your traditional companies which are generating profits. They are making losses not just at the net profit level or the bottom line level, they are making losses even at the operating level. So if the EBITDA is also negative and you do not understand that business, and if they bleed these 1,000 2,000 crores year after year, then you are staring at negative net worth after 3 years or 4 years. So you don't know whether they are going to be going concerns. They are in fact growing concerns. So therefore, if you do not understand these models, stay away. So as long as you know some of these hygiene factors you keep in mind, you are not going to lose out. So anything which is a risky stock in my definition, which is either a penny stock or these loss-making companies, which you don't understand. If you know that they are going to turn around and make a profit, then that's another story. But if you don't know that, and currently you are looking at staring at losses quarter after quarter, then stay away. So then there is nothing like risky. But if you talk from a P multiple, if you think that optically the valuation is high, but it's coming with a very high growth rate, and it's a sunrise sector, it's a sunrise business, it's a company whose competitive advantage is increasing year after year versus the market, then you can pay a premium also to buy those businesses. I don't term them as risky. I think finally the time has come for the defense space also in India. I think the government is actively now looking at giving more and more work to Indian companies, coming up with PLI schemes also. I think there is adequate work given to defense PSUs, and they've been outsourcing a lot of their work to private companies in India. Uh, so I think this is a good space, and it's not even very expensive. By and large, what you get on the listed fronts is all PSUs, uh, and not too much of the private sector. But those defense PSUs also have visibility of 5 or 10 years, because if somebody is making a submarine or somebody is making a aeroplane, then the orders have come to them for 5 or 10 years or 15 years. So that visibility is there, and in a lot of cases they are also given advance money to start their work, and therefore they are not stressed or strained for cash. And in fact, what tends to happen is that they are 3 years 4 years into the order, and then there is an upgrade requirement that comes from the army or the navy or the air force, and that is added to your existing order. So from all these point of views, I think it's a good space to be in. Also because there is margin of safety, they are not stocks quoting at very high multiples, especially the PSU ones. So I think by and large, speaking about the industry, I think yes, the time is right, the time has come, and these contracts will keep coming. More and more work to Indian companies will keep happening, and therefore you should look at these defense plays.
The last couple of questions. Your views on the US market. Is it the right time to enter there, given that it's at it is at almost the 52-week slow? And second is your views on the on investing on cryptocurrencies.
Okay, let me tell you the second one first. Anything that is in a legal bind, there is issues around regulation. There are issues around also fundamentally how to evaluate them. It's best to stay away. So like I was saying, I mean, anything that's risky in my definition is these things that we don't understand, and therefore I think it's best to stay away. I mean, why the lure for Bitcoin when you have 6,000 stocks listed on the exchange to choose from, and within that you at least have a good 500,000 stocks which are of reasonably good quality and reasonably good quality managements. So I would say the answer is a definite no. It's best to avoid, and I would therefore not give any view on Bitcoin or cryptocurrencies. Coming to your first question on the US market, Uh, well, I think US market can see a bounce back, uh, and I cannot put that uh, as a event that will not happen. But let me again come back to my view on market cycles, because I'm a firm believer in market cycles. I feel if you go back to 2003, 2007, which was a mega bull run in India, at that point, when the Indian equities or Nifty as the benchmark rallied 5 to 7x, the US equities during that period went up only 60%. If I see a similar situation panning out in the next 4 years, if once this bond market stabilizes, the INR stabilizes, some point the market starts thinking that the Fed will not hike and maybe in future they can cut, inflation slightly tames off, people announce world over that they're going to invest in new capacities to have more energy security in future. Once you have these things happening and there is more clarity, if we get if not such a big 5-7x return kind of a scenario, but even say a 15-18% CAGR kind of return scenario for India for 3 or 4 years, then there is no reason why you should look at US equities. When Indian equities are in a long bear market, you can. There is a time always to look at global equities, but I don't think this is the time, because US has already substantially rallied from 2009 onwards till about 1 year back. So at this level, I would place my bets on Indian equities more than US equities. Secondly, even from a currency point of view, because to invest in US, you will trade your Indian rupee, and take the dollar. If dollar has rallied so much, and our house view is that rupee will stabilize at 84, 84 and a half, then why would you exchange your currency at this rate of the dollar? So both from a market cycle point of view of equity returns and a currency standpoint, I would not be a big buyer of US. But short term, short answer in the short term is yes, a bounce back in US is possible.
Thank you. I think most of the questions are over, but we can't let you go without a rapid fire round.
Okay.
So, the quick ones, the sectors you're banking on.
Sectors of banking on, like I said, I mean, banking, real estate, infra, and everything linked to infra and real estate. So that's building materials.
What is Amar Ambani's buy for this Diwali? Stocks only.
Stocks only. I would say again, like I said, I have small caps too, but for that you'll have to contact me separately. In the mid cap space, I would say go for Polycab, go for Federal Bank, go for Dixon.
A niche investment instrument that has caught your eye.
Investment instrument, equities. Equities keep catching my eye all the time. I am a big fan of equities, and all I search for is alpha ideas.
How are you deploying your fresh capital?
Well, currently I have raised some cash, which is what I have adequated also to some people, because near term seems a little expensive. But I think how am I deploying my cash? Taking a vacation very soon, and after that, constantly looking for
That's
ideas
the
in
best idea.
equities once I find a margin of safety.
Thank you so much. You've answered all the questions, and I think that's all we have time for. So thank you so much for your time, Amar. And I would also like to thank all the participants to have taken out time to join us here on this webinar. Thank you so much.
Yes, thank you, everybody. There was an interesting match going on, so I appreciate you taking the time out and being on this call rather than watching the match. So thank you, and see you again.
Thanks.